people who are not able to join us this evening can listen in after the event. So without any further ado, I want to turn it over to Lucille, who is our organizer this evening. She's a financial advisor at Morgan Stanley. She pulled the panel together this evening and is also one of our panelists. Welcome, Lucy.
Got it. Thank you, everybody, for taking the time to tune in today. I think we've got folks tuning in from across a lot of time zones. And given this year's stock market performance and current events, I expect we're going to have a very lively discussion today. So just 2 admin items before we get going with the meat of the presentation. We're going to try to reserve at least half of the event for Q&A. So as you come up with questions, please just drop them in the chat box and we will get to them in the second half of today's session. And the second point is that if you come up with a follow-up question or have something else you want to talk about for any of the 3 panelists, please feel free to reach out to me after the session. And I'm going to put my contact information in the chat box right now. Okay, so today we will be covering 3 things. Well, so quick introduction. I usually run the HASTE Career Transitions program. And for my day job, I'm a financial advisor at Morgan Stanley. My team specializes in green investment strategies. And today I'm calling in from San Francisco, which is my hometown. And I graduated from Harvard College in 2011 with a major in economics and a minor in English. So what I'll be covering today are just some basic definitions and best practices. We've also got Robbie Klaber of Parnassus Investments, which is one of the largest and one of the most established pure play ESG funds on the planet. He'll be talking about public equities. We also have Shaun Chaudhuri, who is with the Wesley Group, which is a venture capital fund that focuses on energy and clean tech investments. And he'll be covering issues related to the private side of the market. So to start, if I could have a show of hands for who has been investing for less than a year. And this is just so that we can get a sense of the audience. Either hands up on the screen or you can use the buttons. Okay, so a handful of newer investors. It looks like maybe most people have a few more years of investing under the belt. Second question is, how many of you already have a green portfolio? And then same thing, show of hands or the hand button. Okay, so I'm assuming everybody else who has not put their hands up is in the process of establishing a green portfolio, which is why you're logged in today. But okay, so first, a few definitions to level set and make sure we're using the same terms to understand the same things. I will be using the term green investing pretty generally today. And what I mean by green investing is that it's a rational investment framework that can outperform over the long term. And this might be by anticipating changes in political or social priorities. But the general idea is that if companies can effectively embrace better business ethics, whether that means environmental responsibility, respect for human dignity, or other criteria, then we'd expect these companies to be able to outcompete over the long term. And that could be by offering a better product or service, developing a stronger relationship with your clients, maybe attracting and retaining better talent, and avoiding structural risks over the long term. So that's a very general way of defining green investing. I'm sure that you've heard other terms used like ESG, SRI, DEI, impact investing. So all of these approaches, kind of fall under this responsible green investing umbrella. It's just that these other approaches might use a slightly different set of criteria to define what is good and what could generate that outperformance. And one way to differentiate green investing from conventional investing is that conventional investing may focus more narrowly on a set of shorter term, maybe business only metrics. So just high level, kind of level setting for what I mean by green investing today. And one more kind of note is that this basket of investing disciplines is constantly improving as the tools available to us evolve, as the data that needs to be reported gets more standardized, and as the ability to collect that data gets better. So what green investing would probably mean 5 years from now, I think will be a little different from what it looks like today. So quickly, just 4 very general best practices to keep in mind as you think about your green portfolio. The first thing is to prioritize. So just as you need to understand the level of risk you're comfortable tolerating in a portfolio, if you choose to invest responsibly, you also need to be clear about how you're prioritizing the issues you'd like to impact with your investment dollars, whether that's climate, gender lens, diversity, or inclusion. And the reason I say that is because it can be difficult for a single investment strategy to hit every metric equally well. Some oil companies like Shell are actually quite supportive of their female workforce, and they have very strong maternity packages. So there are other situations like that to be aware of. So just be clear with yourself, have a conversation with whoever you might be working with to set up an investment portfolio. The second thing is that generally, green investments should be part of a long-term, not a tactical short-term investment portfolio. So by definition, we're trying to address more complicated long-term issues with this style of investing, and these issues take time to resolve, and it's difficult to measure progress against quarterly reporting requirements. The third thing, and as I say this, you might be thinking, well, I've already invested my money. The market is down nearly 20% this year. What can I do? What can I do right now? And this third point is more financial planning related than investment specific, but generally when markets are down is a good time to consider realizing taxes on asset values that have declined and funding trusts. So these are 2 slightly more technical things to discuss with your advisor or estate attorney or CPA. And the last thing is the fourth point is to stay educated and to stay engaged and to vote your shares. So the tools we have are changing. The environment that we're trying to deploy these strategies in are changing. So just kind of stay up to date. If you have any portfolio specific questions, or if you just want to share your experience with green investing so far, whether it's good or not so good given this year, please don't hesitate to reach out to me. I'd really welcome that conversation. So next we have Robbie, and I will hand it over to Robbie for a review of issues on the public equities side.
Great. Well, thank you, Lucy, for putting this together, and it's really a pleasure to be here. So, you know, I've worked in the ESG industry for the past decade, and so I thought it would really be helpful to start out with some historical context around ESG, kind of where it's been, and then share a little bit about where it's going. So I didn't go to Harvard College, but I went to Harvard Business School and graduated in 2012. And so at the time, Parnassus was managing about $4 or $5 billion in assets, very small firm. And I would say from 2012 to 2014, ESG was really a very tiny part of the investment universe. Coming out of HBS, friends thought it was quote unquote cute that I would decide to join an investment firm that also invests with its values. Friends would oftentimes ask me, hey, you know, why not just work at a traditional investment firm and then volunteer to nonprofit on the side? And really, during that time, Milton Friedman's view of the corporation, which was that companies should, you know, exclusively focus on maximizing profits, that they shouldn't be concerned about stakeholders, was the dominant view. And as an investor during this, you know, 2012, 2013, 2014, it was very hard to get ESG data from companies. You know, when I meet with CEOs and CFOs from the largest companies in the country, in the world, during this time period, you know, CEOs and CFOs had no idea about ESG. When I would ask them an ESG related question, their faces usually went blank, and they said, well, let me refer you to our head of CSR, which was corporate social responsibility, and that person can answer those questions for you. So that was kind of where the state of the world was then. In 2015, we had a meeting at Disney's headquarters in LA, and Bob Iger, who was CEO at the time, it was unclear if he was going to make the meeting or not. Ultimately, he shows up in the conference room, and he walks in and he says, "Tell me everything you know about ESG." And so that's when it hit me that we were at an inflection point and that ESG was about to become big, really big. And it was the first sign that major companies were beginning to view quote unquote ESG issues really as business issues. The first sign to me that, you know, topics like climate, data privacy, human capital, product safety, etc., that they could really enhance a company's value if managed correctly and effectively. So that was 2015. And then I would say from 2018 to where we are today, present day, ESG has just exploded. And you know that something has gone mainstream when Elon Musk is tweeting about it. And for those of you who follow his Twitter handle, it was just a couple weeks ago that he was tweeting about ESG. And so today, I just had my 10-year HBS reunion, and all my friends who were laughing at me that I joined an ESG firm in 2012, today they claim to be ESG investors themselves. So that's it's pretty incredible. So, you know, why do I bring up this brief history? Really to point out the fact that with everyone claiming to be an ESG investor today, greenwashing, which is a term that basically talks about, you know, basically everyone claiming to focus on ESG, that's a huge risk to the industry overall. And so the question is, you know, what can funds that are doing it effectively do to deal with that? And so I could talk to you about what Parnassus has been doing. And, you know, for us, our focus has been on three key areas. Number one, measuring quantitatively the impact of our funds. Number two, leaning into our investment process, which uses ESG as a key lens to evaluate companies. And number three, engaging with our companies to make them better. So this slide that's up here is a great slide that shows how we're using ESG analysis to improve our stock selection. And so when we evaluate companies, we're using 4 different lenses to evaluate companies. The company's moat or competitive advantage. What is it that gives the company an enduring competitive advantage? Is it a network effect, high switching costs, iconic brands that command pricing power, etc.? Lens number 2 is around relevancy. What is it about the company's product or service that enables them to not only gain share in the broader economy, but also gain share in their industry or sector? Number 3 is management. How is the management team allocating capital? Are they good stewards of our shareholder capital? And number 4 is ESG. And so all our analysts here at the firm, when they're evaluating a company, they put together what's called an ESG risk report, which evaluates how the company performs based on the E, the S, the G, so the environmental, the social, and the governance factors that are most material for that industry or sector that the company operates in. And it's after analyzing the company's performance that analysts score the company's material risk and reputational risk. And so as you can see here, material risks are really risks that may affect the financial performance of a company, so their P&L, their income statement, and we invest on kind of a 3-year time horizon. So events that would affect the company's income statement over the next 3 years. Reputational risk are events that could impact the company's public perception. And so to give you a clear example, think Johnson, if we're talking about reputational risk, Johnson & Johnson's talc powder controversy and issues over the past year or two. The company's so big that talc powder, that one product line, isn't going to destroy their financials, but it surely has had a negative reputational impact on the company. A good example of a company and materiality risk. So about 1.5 years ago, I researched a company called Vroom. I don't know if people on the Zoom have heard of Vroom, but perhaps you've heard of Carvana, which is the largest player in the used online auto market. And so Carvana is number 1, and Vroom is number 2. And so there's this really compelling thesis out there on Wall Street that the number 2 player, Vroom, would catch up to the number 1 player. And here's an industry that has significant tailwinds behind it. No one likes going to a used auto lot, but there's tremendous convenience from buying a used car online. You could do it 24/7 in your pajamas on a Saturday, on a Tuesday night, whenever. And so there's a pretty compelling thesis. As I was researching the company, it was the first time in my 10-year career that I saw a company get delisted from BBB, Better Business Bureau. I didn't even realize that was a thing, that you could actually be delisted from that organization. And so as I dug deeper into it, I realized that their customer service was just terrible. Buyers, so people buying used cars, they weren't getting the cars with the specs that they thought they were going to get. And sellers, so the people selling their cars, weren't getting paid on time, all sorts of issues actually getting receipt of the money. And so both sides of the equation, the buyer and the seller, they were both having a very poor experience. The stock was about $40 at the time. And so my thinking after doing this ESG analysis was that their margins would go down because they had to invest a lot more into customer service. Their free cash flow would go down. And so I decided to pass on the stock. Today, the stock's about $1.50. And so there's been just tremendous destruction in value, and the thesis that they would have to tremendously increase their investment in customer services, that's exactly what's played out. And so I think one of the big themes that's really important to underscore when thinking about like ESG analysis is so many times the issues that are quote unquote ESG issues, they're not just ESG issues, they're business issues. And the line has blurred between what's a ESG issue and what's a business issue. And basically they're one of the same. Of course, many times, what's a materiality risk and a reputational risk are interconnected. Take Facebook, for example, data privacy, data protection issues. That's both a reputational risk, and as we've seen over the past couple quarters, also has a material impact on the company's financials. So that's how we go about kind of evaluating companies from that ESG lens. If we go to the next slide, I mentioned greenwashing is a real risk, and for those of you thinking of putting money into clean tech funds or ESG funds, really any fund, it's always important to look under the hood. And with everybody claiming to be an ESG investor now, in my role as director of ESG, one of my biggest priorities over the past year has been that we quantify the performance of our funds from an E, an S, and a G perspective. And so just last week, we rolled this out publicly. It's the first time in the company's 40-year history that we're quantitatively measuring the impact of our funds across material E, S, and G factors. And so what this slide here shows is our climate performance. And so if you look at the top left, it shows the greenhouse gas emissions. The column in blue is a fund that I manage. It's our Parnassus Mid-Cap Growth Fund. The green bar is the benchmark, the Russell Mid-Cap Growth Index. And so what this shows is that our emissions profile it's 81% lower than the benchmark. And so basically in absolute numbers, there's about 7,000 metric tons of carbon dioxide equivalent coming from our fund versus 36,000 metric tons of carbon dioxide equivalent coming from the benchmark. So if you invest in the benchmark or if you invest in the fund's emissions are about 81% lower, which is great, showing that our emissions are lower today. But then the question is, how does our emissions profile look into the future? Because we want to make sure that we're on the right track in the next 1, 3, 5, 10, 20 years. And so the chart on the right shows the emission reduction targets. And the left side of the chart goes from no target, which means a company has not set a target, to the right side, which is science-based target, which is kind of the holy grail in the industry. Companies that set science-based targets have committed to reduce emissions in line with the Paris Agreement's goal of limiting warming by 1.5 degrees Celsius, and they're also committed to achieving net zero no later than 2050. And so we want our companies to be on the right side of that chart. And what it shows is 78% of our emissions are under science-based targets versus 51% for the benchmark. Finally, the bottom half of the page here shows our top 5 emissions contributors. And so what this shows is that 2 companies, Nutrien, which is a materials company, and then Hilton, a hotel company, they represent 76% of the fund's total emissions. 2 companies, 76% of the fund's emissions, and these 2 companies only represent 3.9% of the fund by assets. So 4% of the fund by assets, 76%. Clearly, it's very lopsided. And this is really, so why is that? It's a function of the industry that they operate in. A materials company, by its very nature, has a large emissions profile. Hilton, in operating hotels, by its very nature, has a large emissions profile. So then the question is, what are the companies doing about it? And if you look at the right-hand column, emission reduction targets, you see both of those companies have science-based targets. For Nutrien, they've committed to a science-based target. For Hilton, their science-based target has already been approved. So that's a real positive that they're on the right track to limiting their emissions to 1.5 degrees Celsius, and they've committed to net zero no later than 2050. But the bottom 3, O'Reilly, Old Dominion, and Cintas, those companies have no target today. And so the third part of our ESG focus that I mentioned at the beginning was engaging with our companies. And so here's a clear-cut example. We have a stewardship team that engages with the companies that we invest in. And so their goal is to engage with the management teams at O'Reilly, Old Dominion, and Cintas, and move them from no target today to science-based target tomorrow. And so that's a big part of our work as well. And so that's a bit on how we're measuring our impact, how we're engaging, how we integrate ESG into our investment process to do it in a legitimate and authentic way. As Lucy pointed out, Parnassus is one of the original ESG firms in the country, starting back in 1984. And so we've certainly appreciated how big ESG has become over the past several years, but we want to make sure that it's done in a thoughtful and legitimate way. And so that's our focus. And so with that, let me pass it over to Shaun, who I know is going to talk about the private markets.
Yes. Just quickly, thanks so much for that, Robbie. Very thorough. And so that the folks in the audience know, Robbie is actually the director of ESG research at Parnassus as well. So I think you might have gotten a little more than a 101 there, but he focuses on the public side of the markets, and there is generally a little bit more data available for public companies, and Shaun is on the private side, so he'll discuss some of the issues there.
Awesome. Thanks, Lucy. Thanks, Robbie. I always learn so much hearing you speak. The history of ESG, albeit a short one, is interesting. I was looking up last night, and I couldn't find much before the 2010 era. So I think Robbie and his team has really been on the forefront of that. I did see an interesting footnote where people are looking back to the 1700s and recognizing few individuals in US and Europe, Quakers and Methodists, who would actually exclude slave labor from their investment practices. They're calling that ESG. So it is interesting to see kind of how recent the ESG history is. My goal, as Lucy mentioned today, is to really provide visibility into green investing within the private sector. I work at an early stage venture firm focused on investing in the sustainability sector. I'm going to go through 5 key themes today. The first one is just really defining what green investing looks like in the private markets. The second one is really showing what does that mean within the venture capital landscape. The third thing I'm going to talk about is an example of what ESG frameworks looks like for a venture firm. Fourth, I'll share data across the ESG categories, and then lastly, I'll talk about key questions you can ask if you're looking to invest in a fund that claims to have an ESG lens in their investment process. So why don't I share my screen and kind of jump right into it? I think the first thing is to really define, what is green investing in the private markets. When people talk about green investing in the private markets, there are 2 key bucket areas. One is ESG, which stands for environmental, social, and governance, and the second one is really on impact. When we take a look at what that, to define those 2 key areas, what ESG is ESG looks beyond the financial metrics. So you're basically collecting a variety of data outside of the financial metrics to really get a sense of a company's business model, to understand founder intent regarding how to think about environmental issues, regarding the company's carbon footprint, how the company thinks about social issues, regarding diversity, equity, inclusion, or governance issues, thinking about board composition, board diversity, board interdependence. On the impact side, impact requires that every investment that you make will have an impact on the society or the environment. These are often equated with the UN Sustainable Development Goals, which you see here, basically 17 goals that the UN have dictated are essential in order to achieving peace, security for us, for all across the globe. When I think about ESG and impact, I really think of ESG as internal. So really about internal operations within companies. Impact is external impact from a company's business operations. From this, I really want to talk about what is ESG and impact, what does it fit within the venture capital landscape? I'm going to assume that most people on the call have some knowledge of what venture capital is, but this is a very simplistic view of the range of firms that exist. So when we think about the 2 bucket areas, you have a set of venture firms that will always put financial returns first, and then a second set of firms that will always put impact first. On the financial returns first, you'll have generalist firms, which Sequoia, Andreessen, Horowitz. I'm sure venture firms you recognize who are generalist firms that invest in anything, and always are trying to maximize financial returns. Next, you have sector-specific firms, which might focus on one or two specific industries. For example, mobility, buildings, Industry 4.0 applications, cybersecurity. So these are sector-specific firms that will invest in certain sectors only, but are still maximizing for financial returns. Then you have the ESG firms. ESG firms are also maximizing financial returns, but they're also taking in social outcomes as a component of their valuation process. And so as you see here, the Wesley Group, the firm I work in, we kind of straddle the line between sector-specific firms and ESG firms, because we really think by integrating ESG into our investment process, we are maximizing returns and getting a much more holistic view of the companies that we are about to invest in. On the impact side, you really have two key buckets. You have impact and you have philanthropy. On the impact side, you're really focusing on social outcomes first, with financial return secondary. We're seeing a rise of impact-focused firms out there, and then in the last bucket, you have philanthropy, which is really focused on creating a positive impact on the world. Now going into the, what does the methodology look like in the venture capital landscape? In the public markets, Robbie has a lot more data that they have access to and are reporting out on. On the venture capital landscape, just because we're working with such early stage startups, the amount of data we get from these companies are quite limited. And so across the environmental, social, and governance, I wanted to showcase an example of what our firm does to collect metrics across the E, S, and the G across our portfolio companies. So going through each category, the first category is environmental. We really focus on measuring the carbon footprint for each one of our portfolio companies. So what that means is measuring scope 1, scope 2, and scope 3 emissions, which is what the GHG protocol has deemed as a corporation's carbon footprint. We also look at energy use as well, electricity consumed by a company's office. On the social category, leaning heavily on diversity. And so this is diversity of employees at each company from a gender and race ethnicity perspective, but also looking at a C-suite as well, getting a better sense of the CEO, CTO, what does their representation look like in the larger landscape. The second key factor on the social side is jobs created, full-time role created within a given time period. Jobs creation is a good indicator for strong economies. And so this is something that we measure across portfolio companies. On the governance side, really focusing on board diversity, getting a better sense of the board dynamics, and then also looking at the policies that the company has internally as well. So we basically have a wide range of 10 policies we look at for every single company, including data security, FML, paternity, maternity leave policies, anti-discrimination, anti-harassment policies, because we really feel like having policies in place really set for good corporate governance. Jumping right along, that's great that we have a framework in place, but what is a framework if you don't have data that you're actively collecting? I wanted to show a quick readout of what that data looks like in practice. This is our ESG data readout for the environmental sector. This is basically the carbon footprint of our portfolio companies. We measured scope 1 and scope 2 emissions this past year. And from what you can see here is across the portfolio companies, it emitted 164 metric tons of CO2 emissions, which is equivalent to 35 gas-powered vehicles for one given year. I do want to highlight this is what the industry is called as financed emissions, meaning that as the Wesley Group and venture firms don't own 100% of any company. They often own 10 to 20% of certain companies. And so we're basically taking our ownership percentage multiplied by the total emissions from a company to get what is the Wesley Group finance portfolio emissions there. The graph to the right really shows, by company, what is the carbon footprint of each company that we have within our portfolio. The one thing I do want to highlight is that because the venture capital landscape is so early stage and relatively new regarding thinking about ESG practices, there are no current benchmarks regarding measuring and reporting out on environmental metrics across our portfolio. Jumping along, focusing on the social side, this is really looking at diversity at our portfolio companies, specifically within employee diversity and C-suite. As you can see here, this is the breakout by gender and race ethnicity. It is interesting to note when you look at the venture capital landscape, in 2021, only 2% of all dollars went to women-founded companies. As someone who majored in gender studies in college, this is quite shocking that this has not increased over time, and it's a large reason for why we think that there's that venture firms are overlooking certain individuals and aren't backing the strongest founders. And so that's the reason why we're really trying to focus in on measuring diversity metrics across the portfolio companies. On the governance side, measuring the diversity of our board members, but also looking at the policies that each of our portfolio companies has, ranging from bullying to data security, data privacy, and also environmental as well. On the benchmarking side, if you look at the results here, we have 13% of our portfolios have women on the board. On average, Crunchbase saw that women held about 14% of board seats amongst private companies in 2021. So this number is slightly increasing, and the report out from our portfolio is that it's inconsistent it's consistent with what the industry standard is right now, but it's definitely a big area for improvement moving forward. And kind of just wrapping up, but how does this relate to you? If you're looking to invest in an ESG focused venture firm, what are kind of 5 key questions you should be asking? I think first and foremost, you should be checking to see, does the firm have an ESG or responsible investment policy in place? I think that's step 1 for any venture firm who's serious about being an ESG investor. I think the second question is, do they collect ESG metrics from the portfolio companies? It's a given that they're collecting financial metrics, but if they're not collecting any data regarding the environmental, social, or governance impact of their portfolio companies, it might raise questions for how deep the commitment is on the ESG side. Thirdly, just do they have a process for integrating ESG into their pre-investment or post-investment stage? This could look like a questionnaire of really kind of gauging founder intent as they look at companies to invest in. Lastly, are they aligning with any third-party organizations? There are some great organizations out there putting out standards such as Principles for Responsible Investing, Venture ESG, Diversity VC, who are basically validating that venture firms are committing to ESG practices that they're claiming they are. So as you look to potentially invest in the venture capital landscape, I think there are some key questions you can ask. And Lucy, with that, I'll give it back to you.
Great, thanks so much for that. I feel like that list of specific questions to share with VC funds and maybe even PE funds for folks who maybe hold those is a really helpful tool. So thanks for that, all that content. I think the first question, sort of combining a couple of questions, is that all the things that we've covered so far is somewhat metrics heavy, and we cover a lot. So for the people on the call who are not technical practitioners and who do not do this as their full-time job, are there a few key red flags to watch for, or green flags to watch for, to make sure that, or to try to ensure that they're working with the right fund managers or looking at the right types of investments? Oh yeah, go ahead, Robbie.
Just I could a couple quick things. On the public side, it's really important to analyze the holdings of what's actually in there. And there are some. It's funny, when I speak with clients, I would say 90% of the clients, they say, "Do you own Facebook?" "No, we don't." "Okay. Do you own? Are you guys?" So we're also fossil fuel free, so we don't invest in energy companies. And so they ask about that. They ask, "Do you own Amazon?" "No, we don't own Amazon." It's like, all right, you guys are good. You guys are good. So my point is that there are a couple companies that are known to be quite controversial, and so just looking at the holdings for a fund is very important. It's also important now, there aren't that many funds that are reporting on ESG performance, but I think that is the next wave. That is where the industry is going. And so for the funds that do report on it, how are they performing? And the ones that don't report on it, you have to, if you're looking at the holdings and you see some things you don't like, you may wonder if they're not reporting because there's not the impact that the ESG impact that they want to have, and so that could be why they're not reporting on ESG metrics. So those are a couple of things on the public side to think about.
Well, thank you. And I'll add one more thing. So now there are quite a few free publicly available resources for kind of non-professionals to use. One of them is As You Sow, which I will put in the chat box now, which is a nonprofit organization that publishes kind of updates on how corporate resolutions are going, kind of in layman's terms, and also has rankings about how different funds stack up against various metrics. So I think that's a good, easy to use resource to see kind of how your current holdings stack up. I think anything else to add on the private side, Shaun, or did those 5 questions kind of cover, like, those are pretty good?
Yeah, I think I mean, in the venture capital landscape, I do want to highlight, it's a bit earlier, and so I think venture firms specifically in the U.S. are just trying to figure out what is their ESG strategy, what is their ESG journey. I think a lot of firms started thinking about this in 2020. A lot of the change has been actually driven by investors in funds, which is interesting. So a lot of LPs, particularly in Europe, have been really pushing for more mandates regarding ESG data collection for funds they invest in. So if you really follow the power dynamics, I think the LPs are really driving the change within the venture capital landscape.
Cool, thank you. And this next question is about how your teams try to put numbers to more subjective issues. So I know Robbie actually did not have time to present his slides about how Parnassus measures social and governance issues. And Shaun is actually doing quite a lot of work for his fund around diversity, equity, and inclusion. But could you give us a sense of how your teams put numbers to more kind of more subjective, maybe harder to quantify issues?
Yeah, sure. I can start. So we do measure performance across S, social, and G on metrics that are most material to us as investors. And so, what are those metrics?
Sorry, just a quick. What do you, for the audience, what do you mean by material?
Great question. The issues that are most likely to impact the financial performance of a company. Again, getting back to issues that are not exclusively quote unquote ESG issues, but are really business issues that can drive, the success of a company. A great example is so one of the metrics on the social side that we evaluate is a company's human capital development. So how does a company attract and retain top talent? Clearly, a topic like this, it's not just a ESG issue, but it's clearly a very important business issue. Customer quality is the second issue that we focus on the social side, which is about the product quality of the products that the company produces. So are they frequently subject to recalls? If not, companies would get, if they are, companies would get dinged for that. And then data privacy. I think if there was a fourth letter in addition to E, S, and G, I think one of the biggest emerging areas for the next decade or two is going to be data privacy, data protection. What is the data strategy for companies? And I've seen companies from traditional consumer staples companies to financial companies to technology companies all have data breaches, and where the day of a data breach, the stock is down a material amount, 5, 10, 15%. I mean, remember Equifax from, I think that was 2017, many other companies that have suffered data breaches. And so what is the programs and policies in place that companies have? And so those are 3 of the metrics that we use on the social side to evaluate our companies versus the benchmark. And then on the governance side, a lot of it is related to, we measure boards with at least 30% female directors, diversity among board members, and then boards with independent chairs. And with independent chairs, that's best practice from a governance perspective. You want the CEO not to also be the chairperson of the board. Rather, you want the CEO to report to an independent chairperson for proper governance. And so those are the metrics on the governance that we're focused on.
And I couldn't, or just to add on to Robbie, I mean, I couldn't agree. Data security is extremely important. It is kind of shocking to see the large number of energy companies and water utilities who are targeted from these ransomware attacks and cyber attacks. Companies that hold very sensitive customer data. So couldn't agree that's going to be becoming a bigger focus of ESG moving forward. I think on the private market side, I mean, how do you put numbers around these subjective issues? I think step one is to really define what is the baseline. And so the large kind of data readout that I did, that I just showed you, was really meant for us to establish a baseline of what are there any benchmarks regarding environmental data, social, diversity data out there in the market, and then what is our current baseline? How can we improve on years to come? I think a question we get asked a lot is why is it important to have diversity? Well, I think there's been a lot of research done by McKinsey, HBS that talked about how diverse teams outperform non-diverse teams. Diverse teams are really able to reach the customers of tomorrow, create the products for tomorrow. And so that's kind of why we really anchored on a lot of metrics on the diversity side. Is we really do think it's going to be core to building a sustainable business model. So regarding kind of putting numbers to subjective issues, I think that's why we really heavily on the data collection side. When we think about the screening process for potential investments, it is a little more qualitative. You're really kind of trying to gauge founder intent regarding how does the founder think about, where to prioritize their environmental footprint of their company? How does the founder think about building a diverse team? And so those are a little bit more subjective, but we really rely on the data collection we do each year for portfolio companies.
Got it. Cool. And I guess staying on the issue of data, we've gotten a few questions specifically about emissions. So why focus on CO2 versus other types of emissions? Are downstream emissions kind of included in the thinking? And maybe how I would reframe this question a bit is, of all of the data that's available, how do you prioritize and choose what you look at? Is it depending on where you think data is the cleanest or the most standardized and easiest to compare between companies? How do you choose your data sets?
Robbie, you have a lot more data than I do, so I'll let you go first.
Sure. So the metric we use is metric tons of carbon dioxide equivalent. So I saw there was a question of, does that only include carbon dioxide or other things included? It does include other greenhouse gases like methane and nitrous oxide, and so it does capture that. Now to the question around, there's scope one, which is like direct emissions. Scope 2 is indirect emissions. Scope 3, I saw there was a question about that. That largely relates to you can think, what are the emissions associated with the company's supply chain? And our focus is around scope 1 and 2, because we've seen data quality and data reliability be the highest for scope 1 and 2. Scope 3, even in the public markets, all of that is modeled. And so you've got big third-party data providers modeling out a company's scope 3 emissions, basically the emissions associated with the company's supply chain. And so it's highly inaccurate, and we just don't see we don't see the need to kind of report on something where we're not even confident in the reliability of the data. And so that's a big reason why our focus has been on scope 1 and 2 and evaluating companies based on performance on those metrics.
Yeah, I can agree with that. I mean, more in regards to our reporting out, on the private side, you just don't have access to this data as readily as public markets. And so for us, we basically have to go to each of our portfolio companies and ask them, for their scope 1, scope 2, and scope 3 emissions. As you can probably tell from the reporting outside, we committed to measuring scope 1 and scope 2 this past year. Exactly for the reason why Robbie mentioned, it's a bit easier for us. We're able to glean that off of their utility bills. We take the utility bills and do the calculation for them for the scope 1, scope 2. Scope 3, I read a stat where I think for the companies that report out, public companies that report out in scope 3, I think 50% of the data reported is considered inaccurate. So there just needs to be a fundamental shift in the industry for a much more rigor regarding measuring your upstream and downstream impacts of your company's GHG emissions. So our goal as a venture firm is to start measuring out on scope 3 emissions in the coming years, and we're going to start off with a small subset of scope 3 and expand that over time. We are looking to become a carbon net zero portfolio, and what that means is to really truly measure scope 1, scope 2, and scope 3, and then eventually reduce emissions over time and offset whatever we can't reduce.
The next question is a little bit, I think, more tailored to the HASTE audience, which is climate and environment focused folks. So one question is, if you believe that the most critical issue going forward is climate change, and this area represents the biggest long-term opportunity, kind of where in the investment world are you most excited to allocate money? And I can add my thoughts after Robbie and Shaun kind of share their perspectives as well. Okay, I mean, or I can also start. So I think it's a pretty broad question because there are different asset categories where an investor can put money. So as we've discussed today, Robbie is in the public markets. So the companies he looks at are further along. They've gone public. They're listed on an exchange. There's standardized reporting for how they're required to share data. Shaun is in the private side of the world. So venture capital is private. Private equity is also private. A lot of these venture capital companies are much earlier stage. Often they're smaller, they're more experimental business models or technologies, and there are actually also legal constraints around what types of investors can put money into venture funds, because often those investments are a little bit riskier and a little bit less liquid, which means if you need to pull money out, you may need to wait some more time, longer. And it's a similar situation with private equity funds. So I think there are a lot of established companies that are trying to improve their existing climate footprint in the public space. And that is much easier for most investors to access. There are some very exciting companies working on more experimental technologies in the private space, sort of in VC. That is a little harder for the average investor to access, and also a little bit riskier. So, and there are also green bonds. A lot of local municipalities and states issue debt for clean energy infrastructure projects that they're working on, but the return and liquidity profiles of those assets are also different. So I think it seems like a kind of a straightforward question, but the answer really depends on really how much spare cash you have, what level of risk you're able to take, and how long you can keep that cash locked away, in addition to kind of interest and tolerance in kind of these climate oriented investment areas. So
and at least on the public side, companies that are highly exposed to kind of a climate transition, you could think of like the Sunruns of the world. it's important to pay attention to what's happening in DC around different bills and policy changes, and how quickly that's happening or not, because that definitely has a big impact on how those stocks act on a monthly and quarterly basis.
Cool. Well, for Shaun, maybe is there any companies you've seen on the private side that are working in an area that you find particularly exciting? And you don't need to list the name, maybe, because I think it's what VCs like to protect, but is there an area that you're particularly excited about?
Well, I'm pretty transparent, so I'm always happy to share names. If you have interest, find me later. I think in general there are definitely a lot of themes that are really exciting that we're diving deep on. I think I'll list 3 right now. One is on the climate risk space. So with the rise of extreme, I don't need to talk. I think I don't know where you're located, but with the rise of extreme weather events accelerating, we're seeing business operations and business supply chains really strained. And so there's a whole bunch of companies that are really coming onto the scene to really help out, to help companies assess what is your physical risks based off these extreme weather events, and what are your transition risks as we think about a low carbon future. The second interesting subsector has really been on the carbon management side, which is prevalent to everything relevant to everything we're talking about today. A lot of companies are really trying to help corporations understand what are your scope 1, scope 2, and scope 3 greenhouse gas emissions. We invested in a company called Circular in London, which really focuses on scope 3 emissions, knowing how complex the problem is. But they basically focus on industrial supply chains, following the materials from the mine all the way to the factory of their customer, which in most cases are large automotive companies, large technology companies that have physical products. And so they're really honing on the scope 3 emission side. The last area that I think is really interesting is in is what I'm calling climate fintech. There are a lot of interesting fintech plays there that have a sustainability angle to it as well. This could look like neobanks. There are a couple of companies that are realizing that when you bank at some large banks, you may not have visibility into what your funds are being financed. And so there are some neobanks coming onto the scene to guarantee that all your capital is going towards supporting green projects. So I think those are the kind of 3 areas that I'm particularly excited about and diving into now.
Cool, thanks. And we're actually at the end of the time we have, but if anybody has kind of any burning questions left, any follow-up questions, if you have specific portfolio questions or just want to share kind of a good or a bad green investing experience, please feel free to reach out to me. I will share feedback with Shaun and with Robbie, and our teams are always trying to improve our respective processes, and also to get a sense of what how the industry is evolving on the client side as well. So please definitely don't hesitate to reach out. And with that, thank you so much to everybody for taking the time to attend. I think this was it's a big topic, and it's going to be a long-term priority. So I'm glad we were able to have this conversation, and we will be sending out a survey about appetite for a deeper dive into any of these asset classes. So thanks again. Have a good evening, or a good morning, or a good afternoon, wherever you're dialing in from. And thank you to Robbie and Shaun for your time. And thank you to the rest of the HASTE team who were in the background piloting the Zoom. So thank you.
Thanks everybody.
Thanks everyone.